Hello guys, welcome to a new video, and as you can see from the title, we are gonna discuss all about Vega. I've been getting a lot of question about this option Greek, and it is not so much well known as the theta and delta, but I'm going to explain you in Vega in a very simple term, and I'm going to divide this in three parts. So the first we are going to discuss what is Vega and how does it actually impact the option price. And the second, we are going to discuss how you can use Vega to your advantage when it comes to profiting out of Vega. And the final part, we're going to discuss does Vega really matter? Why we don't hear much about Vega as compared to Theta and Delta, right? So that would be my final part. If you are interested in all that, then please do stick around. And with that, let's start. Okay, so what is Vega, right? So in terms of definition, if you ask me, Vega measures the rate of change in options value given a 1% increase in the change of IV, right? So let me break it down in this. So Vega is kind of closely related to IV. So as soon as you see that IV moves by 1%, your option value is gonna increase by how much? That how much is decided by the Vega, that's all, right? So let's say take an example, right? Let's say one stock is at $100, okay, and with the IV of let's say 2%, just for the sake of it. And then let's say the Vega for that is 25 cents, right, which is 0.25. And now let's say IV increases from 2% to 3%, right? So how much the stock price is gonna move, right? So that's is going to move by that 25 cent. So your new price would be $100 and 25 cents. So that is going to be your new price. So that's how the price is decided by that amount of Vega, right? So that's all that Vega is. Second part, we are going to discuss how you can use that to your advantage, right? So but before going that, I want to quickly touch upon a few more aspects of the Vega, right? So Vega, as I said, it is very closely related to IV, and that is the reason it is it's very tricky to find the right value for the Vega, right? So because the IV itself is volatility, if you know, right? It's implied volatility, and the IV itself fluctuates based on the price of the stock, right? So let's say something like a very stable stock, let's say AT&T, right, which doesn't move at all, right? So for that, the volatility would be low. That means IV would be low, and because of that, the Vega increase in that would also be low. So let's say if it moves a few percentage in the IV, right, the Vega value would not be that much. But if you take a volatile stock, right, because the IV would be very high, maybe more than some pharma companies, right, the IV would be more than 100%. In that case, Vega value, if you see, that will be really high. So Vega kind of moves up with IV and then it goes down with the IV, right? So the more the IV, it's a positive Vega, less IV is negative Vega. And this, remember this point, because we are gonna see how you can take this part that I just said. I'm gonna repeat, right? So basically, higher the IV, the higher the Vega, less IV and less volatility, less Vega. And this is exactly how you can use the Vega to your advantage, right? Another point in terms of the options, right? The longer the option, I mean, it's let's say the option is expiring maybe 6 months down the line, your Vega would be high. But shorter the option, the Vega would be low, right? So that's another point. And the final point here is the at the money or out of the money, right? So at the money, your Vega would be higher. Why? Because let's say the chances of getting into the money or out of the money is very high when you are actually dealing right at the money options, compared to something which is way out of the money, right? We can see from one example here, right? I can show let's say in Robinhood, right? If this is SOXL, and if I go to something like let's say these are the at the money right now, right? So at the money, if you look at here, you will see that the Vega amount here, right, versus if you go somewhere out of the money right here. So look at the Vega here, right? So Vega is low compared to if you come down here, right, on the 52, which is right at the money, your Vega is high. So that's the one part of the Vega that you need to kind of watch out for. And another, as I explained in my example before, right, the how the Vega impacts the option prices. So right now if you see for 52 strike price, this has a 1.51, right? So let's say this IV moves to 178, right, which is 2% up. So how much this price, new price, would be? So that calculation would be basically you add this into this price, right? So you add like how many percentage? So 2%. So you add 2 multiplied by this, and that's what you need to add it here. So that's how the Vega impacts the option price. Now we are going to see how you can actually make use of this Vega to your advantage. Okay, so on the second part, as I mentioned, we're going to see how actually you can use this Vega to your advantage, right? And more importantly, as an option seller, how you can take advantage of this Vega, right? So as I mentioned, the higher the Vega, the higher the IV. So basically, the higher the volatile a stock is, the Vega is going to be higher for that particular stock, right? And so if you think, right, when the volatility of a stock is higher, mostly it would be obviously higher around any big event, right? One of the regular event that happens for a stock, that is their earnings, right? So earnings is the event that happens regularly, and as the stock run up to that earnings event, their IV is gonna increase, and that's gonna increase the Vega too. And when does it goes down? It goes down immediately after the earnings. So as an option seller, this phenomena you can use to your advantage is called IV cross. So basically you are, let's say, you buy a call debit spread, right? And then as soon as the earnings come out, even though maybe stock can do anything, it can go up or it can go down, but one thing that is gonna remain common, that is gonna be the IV or the Vega, right? That value is gonna down, so you can sell high and then you can buy back the same stock. So just for an example, right, you can let's look at so you can go to the Nasdaq, and this shows the earnings calendar for you. So I'm just looking for, let's say, June 4th earnings, right? So as you can see, the crowd strike has the earnings coming up. So if you go back to the Robinhood, right here, if you see, this is the crowd strike options, and here if I look at let's say I plan to sell put, right, on this. So if you look at the implied volatility, right, this is more than 100%, which is pretty high, and the Vega goes along with that, right? So think of this IV, if this goes down, right, let's say as soon as the earnings are over, this is definitely gonna go down. It doesn't matter where the stock is, and as soon as, and let's say it goes down by 10%, right, your stock is gonna, as I mentioned, for a 1% decrease or increase, this is the amount, the Vega amount decides what's the new premium price would be, right? So if it goes by 10%, you can that multiply and find out what your new price would be. So you can sell at this price and then you can buy it back, and the difference is gonna be your profit, right? So this is how you can use IV or a Vega to your advantage. Okay, the final part, right? And as I mentioned at the beginning of the video, this part is, does Vega really matter, right? And I wanted to keep this intentionally for the last part of this video, because I wanted to give you guys an overview of the Vega and how Vega works, but does it really matter? Should you care about Vega? So the simple answer is no, it does not matter. but it does not matter in comparison to the other Greeks, right? There are far more important Greeks that you should be well versed of before you kind of try to go deep into the Vega, right? The rule of thumb is as long as your delta and theta are aligned and you understand what you are doing with your delta and theta, you should be good, right? You should not worry about Vega at all. Don't worry about Vega. Just keep your delta and theta as an option seller. Theta is really important. If those two are done correctly, you would be a very good option trader. Vega is not important, even though it does matter in some cases, as I mentioned in part 2, but in overall total scheme of things in options trading, delta and theta plays a far more important role than Vega. Okay guys, so that was a video about Vega. If you have any questions related to this or anything about options trading, you can always put your questions down in the comment, and I do read through them as I get time, and I will definitely respond to them. So do put your questions, and guys, if you have not subscribed yet, please do so. I make a lot of videos and I'm sure you're gonna benefit with that. I'll talk to you in my next video. Till then, happy investing. Bye bye.